The estate planning domain represents approximately 10% and focuses on the orderly transfer, preservation, and management of wealth during life and after death. Estate planning is an essential component of comprehensive financial planning because it helps clients protect assets, minimize taxes, provide for beneficiaries, and ensure financial continuity during incapacity or death. CFP professionals must understand legal documents, tax implications, trust structures, beneficiary arrangements, and transfer strategies that align with client goals and family circumstances. Effective estate planning balances financial, legal, and personal considerations while preserving family harmony and reducing administrative burdens for future generations and beneficiaries. Property titling and beneficiary designations are fundamental elements of estate planning because they determine how assets transfer upon death. CFP professionals must understand ownership structures such as joint tenancy, tenancy by the entirety, community property, and sole ownership. Beneficiary designations associated with retirement accounts, life insurance policies, and payable on death accounts often supersede instructions contained in wills. Proper coordination between property titles and beneficiary arrangements is essential to ensure assets pass according to the client's wishes. Financial planners evaluate these structures carefully to minimize probate complications, preserve tax advantages, and avoid unintended asset transfers. Effective beneficiary planning also improves estate administration efficiency and reduces the likelihood of disputes among heirs or family members. Strategies to transfer property involve methods for moving assets efficiently during life or after death while minimizing taxes and preserving wealth. CFP candidates study gifting techniques, charitable transfers, family-limited partnerships, and trust arrangements designed to support long-term estate objectives. Property transfer strategies may also involve lifetime gifting programs that reduce taxable estates while helping family members financially. Financial planners help clients evaluate the advantages and disadvantages of different transfer methods based on family structure, tax exposure, liquidity needs, and charitable goals. Proper transfer planning allows individuals to maintain greater control over asset distribution while reducing legal expenses, minimizing tax liabilities, and protecting family financial security across multiple generations. Estate and incapacity planning documents provide the legal framework necessary to manage financial and healthcare decisions during incapacity or after death. CFP professionals must understand the purpose and structure of wills, revocable living trusts, durable powers of attorney, healthcare directives, and guardianship arrangements. These documents help ensure that an individual's financial and medical preferences are followed when they are unable to make decisions independently. Estate planning documents also streamline asset distribution and reduce uncertainty for family members. Financial planners frequently coordinate with attorneys and other professionals to ensure estate documents align with broader financial goals, beneficiary arrangements, and tax planning strategies while maintaining compliance with applicable legal requirements. Gift, estate, and generation skipping transfer (GST) tax compliance and calculation are important because taxes can significantly reduce transferred wealth. CFP candidates must understand federal estate tax exemptions, annual gift exclusions, portability rules, taxable gifts, and GST tax structures. Financial planners help clients design strategies that minimize transfer taxes while preserving intended distributions to heirs and beneficiaries. Proper compliance with reporting requirements and tax calculations is essential to avoid penalties and disputes. Estate tax planning often involves coordinating lifetime gifts, charitable contributions, trust arrangements, and valuation discounts to reduce overall taxable estates. Understanding transfer taxation allows financial planners to recommend efficient strategies that support both wealth preservation and long-term family financial objectives. Estate liquidity and trust planning are also major components of the estate planning domain. Estate liquidity refers to the availability of cash or liquid assets needed to pay estate taxes, debts, administrative expenses, and ongoing family obligations. Financial planners may recommend life insurance, reserve accounts, or strategic asset allocation to ensure adequate liquidity during estate settlement. Trusts are widely used tools within estate planning because they provide flexibility, privacy, asset protection, and tax advantages. CFP professionals must understand the types, features, and taxation of trusts, including revocable trusts, irrevocable trusts, charitable trusts, and special needs trusts. Trust planning allows clients to manage asset distribution while maintaining greater control over long-term family wealth preservation. The marital deduction and intrafamily business transfer techniques help preserve wealth within families while reducing estate tax exposure. The unlimited marital deduction allows assets to transfer between spouses without immediate federal estate taxation, although taxes may apply after the surviving spouse's death. CFP professionals also study family business succession strategies, including buy-sell agreements, installment sales, family partnerships, and gifting programs designed to facilitate ownership transfers. Effective business transfer planning ensures continuity of operations while preserving retirement income and family relationships. Financial planners must carefully balance tax efficiency, liquidity, ownership control, and succession objectives when helping business owners transition wealth and leadership responsibilities to future generations or selected successors. Post-mortem estate planning and planning for special circumstances complete the estate planning domain by addressing complex family and legal situations. Post-mortem planning techniques include disclaimers, alternate valuation methods, and trust elections that may improve tax outcomes after death.